Problem 12.6 asks us to look at the same information as problem 12.5. The name of the company is Adrian Express, and the information is at the bottom of page 593 and at the top of 594 in your text. And again, with all ratios, I urge you to take a minute or two and jot down what it is you need so that you don't go grab the wrong number. It's just really easy to do that. So, our gross profit ratio is sales minus cost of goods sold. That gives us our gross profit divided by sales. So, let's go take a look. They give us our sales number, 19,310,000. They tell us our cost of goods sold is 12,250,000. And we're going to divide that by our sales, which is 19,310,000. So, when we subtract 1250 from 19,310, we come up with $7,060,000. We divide that by the 19,310,000, and we come up with a gross profit ratio of 36.6%. So that's our first ratio, and it says that every dollar of sales yields approximately 36.6 cents of gross profit. 36.6%. Okay, the next ratio it asks us to do is return on assets. And return on assets, let me remind you, that's net income divided by average assets. Now, to get our average assets, we have to take our beginning assets of $7,800,000 and our ending assets of $9,200,000, add those together, and then divide by 2. So when we do that, we come up with, what, 1 million, 10 million, or $18 million, yeah. We just have to add them together, 7.8 and 9.2. We add those together, divide by 2, and we come up with 8,500,000 is the average assets. So 8,500,000 is the average assets. And we divide that into 1,700,000 in net income. And we come up with a 20%. In other words, for every dollar in assets, we return about 20 cents on net income. That's the return on assets. I'm not going to highlight the number because it didn't work. This 8,500,000, which I insist on calling 18, I have no idea, is the 7,800,000 of the beginning assets, the 9,200,000 of ending assets. Add those together, and you come up with that, and then you divide that by 2, and you come up with 8,500,000. That's how you came up with that number. No matter how many times I tried to mutilate it, that's the number, and that yields a 20% return. Our profit margin is a little easier. It's simply net income, a given number, divided by sales, also a given number. So our net income is 1,700,000. Our sales is the same number we give up here, 19,310,000. 19,310,000. And that gives us a profit margin of 8.8%. So that's our profit margin, 8.8%. So for every dollar of sales, we generate about 8.8 cents of profit. That's how you would interpret that. The asset turnover, we're going to use this same number I was mutilating so badly earlier, and we're going to divide that into sales. So it's sales divided by average assets. And to keep from watching me fumble around again, we're just going to take the number 8,500,000. So we take our sales number of 19,310,000, divide that by our average assets, our beginning assets plus our ending assets, divided by 2, 8,500,000, and we come up with 2.3 times. It's kind of a goofy number, but it says based on these sales, we sell all of our assets 2.3 times a year. Clearly we don't. I mean, we don't sell the parking lot, we don't sell the building, we don't sell the shelves, but it's a number that companies can use to compare with other entrants, and it's a number that analysts will use to look at how efficiently a company is using its assets. And that's the asset turnover ratio. That's another profitability ratio. And the last is return on equity, and return on equity is net income divided by average equity. Now in this problem, we only have common stock and retained earnings. So we take our beginning common stock and retained earnings, and that's 3,540,000. We take our ending common stock and retained earnings, 4,880,000. We add those together, we come up with 8,420,000. We'll divide that by 2, and our average equity is $4,210,000. So that's our average equity is $4,210,000. Our net income is $1,700,000. $1,710,000 to be exact. And that gives us a ratio of 40.4%. And what that says is that for every dollar of equity, we return about 40.4 cents. That's return on equity. The key to any of these ratios is to make sure you write down what you're looking for, because it's just so easy to grab the wrong number. Believe me, I've done exercise 12.6 3 times this morning, and I did exercise 12.5 twice. it's easy to grab the wrong number.